What's going on, guys? Welcome back to another video. In this video, I've got another AMC update. So tomorrow, April 22nd, could potentially be a very significant day for AMC. I think we are going to see a lot of volatility, and this has to do with these fully paid lending programs and a staff statement from the SEC. So we're going to briefly cover that again, and I'm also going to give you guys some more insight into exactly how these fully paid lending programs work at these institutions. I don't think anybody is really talking about how these programs actually work. Now, we also have a lot of these big banks creating more of what are called netting accounts, which really suggests that they are preparing for a lot more of these defaults that we have seen out of institutions like Archegos and Infinity Q. So we're going to go over that as well in the remainder of this video. So we have a lot of great information to cover, so make sure you guys stick until the end. And before we get into all of that, if you guys would like to earn 2 free stocks with Webull valued up to $1,850, make sure you check out that link down below in my description. All you have to do is sign up for an account, deposit over $100, and you get access to those 2 free stocks. Now, this is also a great way for you guys to help out and support the channel if you guys would like to, because when you get 2 free stocks, I get a free stock as well. And if you enjoyed the information and analysis that I provide for you in these videos, make sure you go down and hit that like button. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. I've also been seeing a lot of talk about what is called a gamma squeeze and how it's very possible that AMC is going to be seeing one of these in the near future. So let's just pull up the option chain, and I'm going to tell you guys exactly what I am seeing. So when we pull up the option chain for AMC, this is going to be the weekly expiration date, and these $10 strikes are always the specific strike that everybody is always hyper focused on, because they typically have the highest open interest and volume. So in order for a gamma squeeze to happen, we typically need a very high amount of open interest and a very high amount of volume on a short time to expiration contract in order for a gamma squeeze to occur. And then we also need the share price of the actual stock to get close enough to this strike to force the institutions to cover the naked calls that they sold. So essentially they are creating a covered call position. So when the share price gets close to the strike, they go out on the open market and buy the correct amount of shares, which then could create a positive feedback loop and push the share price higher. So when you just go out and buy options, it doesn't actually push the share price higher. So if you guys are thinking, well, why don't we just go out and buy options because we're leveraged and this is going to push the share price up more, that's not really the case. In order for that to happen, you need the share price to actually get close enough to the strike price in order for these institutions to have to start buying these shares. Now, for this week, I don't think a gamma squeeze could really happen. 30,000 contracts is not really enough for me to say that a gamma squeeze is going to happen, and we don't really see a crazy amount of volume on this option chain as well. So I don't want to spread any FUD like a squeeze is not going to happen. I still think that the typical short squeeze that we have been talking about for a long time on AMC is inevitable at the current time. In my opinion, this week, a gamma squeeze, which is different from a short squeeze, is not really going to happen. We also crossed a very important milestone today. When we come over here, this is directly from Ortex, the new record short interest on AMC. The estimated short interest is now up to 23.25%. But again, I still think that that number is a lot higher when accounting for all of the naked short positions, which we are never going to know how many there actually are. And the utilization is at 100%. This means that the institutions are essentially saying, hey, we are willing to loan out this amount of shares, so X amount of shares in total, and the actual amount of shares that have been lent out are meeting that amount. So the amount of shares that have been loaned out are the max amount that the institutions are willing to lend. So technically, there's no more shares to be lent out. And I've seen a couple of individuals reaching out to their brokerages, just asking for information on if there are any available shares to short at some different brokerages, and they are coming back and saying that there are no more shares left to short. So this doesn't really mean that a squeeze is going to kick off right away, but it does mean that we are moving in the right direction, which I think is a very good sign. Now let's get into this SEC staff letter and go into this fully paid lending system a little bit further. So when we come over here, the SEC have told stockbrokers that as of the 22nd of April, which is going to be tomorrow, they must have have the capital on hand to cover every share they borrowed from investors and lent to hedge funds. So stockbrokers need billions of extra capital on hand as of the 22nd, or they have to recall the shares they lent. So this is very important. So these institutions are dealing with clients that have a lot of money in certain positions. So when we come over and look at the actual ruling, or this staff statement, on October 22nd, 2020, commission staff issued a no action letter regarding the broker-dealer customer protection rule, Exchange Act Rule 15C3-3. So let's take a look at exactly what this is. So 15C3-3B3 requires broker-dealers entering into agreements with their customers who lend the broker-dealers fully paid or excess margin securities to provide the securities lenders with collateral that fully secures the loan. So essentially what this means is that they need all of the collateral in order to actually engage in these types of business practices. So when we come over here, we can see that this whole 15C3-3, it all has to do with customer protection. Now, this is a 250-page document, so I'm going to just click over here because this is really where we need to be. This is going to be B. And we can see a broker-dealer shall not be deemed to be in violation of the provisions of the paragraph B1 of this section regarding physical possession or control of fully paid or excess margin securities borrowed from any person, provided that the broker-dealer or the lender at or before the time of the loan enter into a written agreement that, at a minimum, sets forth in a separate schedule or schedules the basis of compensation for any loan and generally the rights and liabilities of the parties as to the borrowed securities. So the reason why there's so much information about these fully paid lending programs is here's kind of how they work. So when you're a big institution and you have a lot of pretty substantial clients and you're trying to get them to lend you some of their shares in order to actually then lend out to the hedge funds, it's not like you're on Robinhood or Webull where you just click on and off with your stock lending and it just turns it on or off and they can do whatever they want. There are a lot more regulations that go into this, and they actually have to market these to their clients. So fully paid lending is kind of the version of the actual kind of button that you would push on Robinhood, Webull, Charles Schwab, any of these that turns on or off stock lending. In some situations, they actually can reach out to individuals and ask them to lend them specific shares of stock, but those are in very niche situations. So this is really just to keep the client safe, in order to not have them actually lose their position or take any substantial losses in these types of positions. Now, some of the liabilities that they're going to say are there's a possibility that due to short selling, the value of their position could decrease, which is why not a lot of these individuals are going to be engaging in these types of lending programs. Now, here's what I find very interesting about this staff letter. When we come over here, we can actually see that the staff statement represents the views of the staff. It is not a rule, regulation, or statement of the commission. The commission has neither approved nor disapproved the content of this statement. This statement, like all staff statements, has no legal force or effect. It does not alter or amend applicable law, and it creates no new additional obligations for any person. So it really doesn't seem like what they are saying in all of here is really enforceable, but we do have rules that are enforceable. So I think this April 22nd date is still going to be very important because we are seeing a lot of lending. Now, since the utilization is at 100%, there's not really any lending that can happen at this point. So it's really just having to do with the management of the lent out shares, which obviously the institutions have done a very poor job of actually managing because the hedge funds have been able to naked short AMC into oblivion. Now, I want to bring you guys over to a more broad concept that could affect not only the broader economy, but AMC as well. So we did see this Archegos collapse, and it cost Morgan Stanley $911 million. Now, when we come over here, we also see that exclusive New York's Infinity Q winds down hedge fund as valuation issues spread. So I want to make sure you guys understand that a lot of these funds are over leveraged. There's interesting valuation practices going on that are causing these hedge funds to get into a lot of trouble. Now, there is a really large Reddit post right over here that I want you guys to take a look at on your own time, but I want to be able to give you guys some of the briefing of what I really want you guys to take away from this. So when we come over here, we can see that DTCC Fixed Income Clearing Corporation, JP Morgan Securities, has been approved for 3 additional full netting services accounts effective May 3rd, 2021, and these are the new account symbols. Back in March, they actually registered for 17 or 15 of these. It looks like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 of these. So their total amount right now just for JP Morgan is 17 new netting accounts. So what exactly is a netting account? When we come over here, netting is a method of reducing risk in financial contracts by combining or aggregating multiple financial obligations to arrive at a net obligation amount. Netting is reduced to reduce settlement credit and other financial risk between 2 or more parties. So now let's come back over to this Reddit post. So let's see right here, DTC may, in extreme circumstances, borrow net credits from participants secured by collateral of the defaulting participant. So right here, what if you are a non-defaulting member and you know that there are going to be member defaults and you know that there will be an auction for their assets at a market discount? How would you prepare for this? Perhaps you'd want to have cash on hand to meet liquidity requirements and emerge from any collapse with assets. How might you go about this? New netting accounts is a great way to do this, but they're not going to come into effect until May 3rd of 2021. And when we come down a little bit further, this really just ties into the overall economy. So the netting account is addressed to the mortgage-backed securities department. You know, the good folks responsible for the financial collapse, who, like other MBS, are good at chopping things up and bringing them elsewhere. So the graph shown by the university researchers shows that the incomes of the leaseholders are 25% to 50% overstated, and delinquency rates are spiking at the same rate or worse compared to 2008 among CMBS. Can you spot the banks that just issued record amounts of bonds this week in the first chart? A netting account would be necessary because the delinquencies are skyrocketing with pandemic support and SLR ending on March 31st, 2021. I believe there is a rampant shorting of the treasury bonds. That is an opinionated statement. We can't really tell that at the current time. And since the SLR now requires disclosure of bonds again, which are heavily shorted, the banks now need to issue bonds to cover their bad bets and the overstated income of their mortgage owners. The netting account is where you settle your bad bets and pick up the pieces. To further reinforce this point, the Infinity Q hedge fund was liquidated because they overstated their net asset value by at least 30%. So when we come over to that article that was referenced, this is going to be the bigger short. Wall Street's cooked books fueled the financial crisis in 2008. It's happening again. So I know a lot of you guys, probably all of you, have seen The Big Short. And if you really look at the end of that movie, they really just say that nothing really happened and they just kind of changed the names of what they are doing. So when we come down further, we can take a look at some of these overstatements. It's pretty far down here. So right here says proportion overstated. Sorry, I can't read vertically. And we can see that UBS right here has a basically 50% overstatement maybe. We can see that Goldman Sachs is up there as well. So basically what this is going to show us, that if some of these hedge funds who are trading in these mortgage-backed securities end up having severe liquidity or over-leveraged issues, we could see more forced liquidations, which could then in turn trigger the AMC and GameStop short squeeze, because if they are forced to liquidate their positions and they're already over-leveraged on these mortgage-backed securities, we could see even more of a squeeze for AMC. So hopefully that made sense to all of you guys. I know we went over some pretty interesting concepts, pretty advanced concepts, but that is going to conclude this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I'm trading and which strategies I am using to trade them. So I hope you guys are having a really profitable day, and I'll see you guys in the next video.